As always, the markets across the globe will be reacting to the Federal Reserve's policy stance, a hawkish pause in September. However, the Fed Chair Jerome Powell did not shy away from indicating that they still expect one more rate hike by the end of this year, which is in November, and fewer cuts than previously indicated next year. Now, if the Fed goes ahead with one more, it would make a full dozen hikes since the policy tightening since March of last year. On that note, let's hear it out from our expert, who's from the chairman's speech, of course. We have our expert joining in, Gurmeet Chadha, who's the managing partner and fund manager, Complete Circle Consultants. Gurmeet, welcome to ET Now.
Good evening. Thank you. Thank you for having me.
Right. So Gurmeet is joining us on the phone line. First up, Gurmeet, Fed's decision is out. Even though Fed is holding the interest rates steady for now, it did point towards, rates staying higher for longer. How do you read into this hawkish stance of Fed?
So it is, slightly negative in the short term because, the 10-year US yield crossed 435. The 2-year yield has been upwards of 5%, and this typically leads to temporary outflows, from the EM basket, which we have seen in the past. So, and I think the only thing was that another thing which was slightly negative is the expectation of rate cuts next year. That's also fallen from almost 4 to now 2 rate cuts next year, and market is something which discounts future, which means the rates are here to stay higher for longer. Which also means that if bond yields are, if you see the yield gap model, if the bond yields are high, the discounting rate for equity goes up, which means that there is some negative impact from a valuation perspective. So as an investor, the overall valuation takes a bit of a knock, which could be negative for especially in pockets where valuations are high in markets. So, that could be some banks which are, slightly expensive. It could be companies in the consumer space. And it also leads to some strengthening of the dollar. So it's all related. The other thing which is a bit of a worry is also rising crude. So my sense is this is short-term negative, but overall, as I said, fundamentals of economy remain strong. Some temporary outflow can happen because of this. But overall, don't see too big an impact because even if you see the Fed minutes, 12 people were saying that they may need one more hike. The seven Fed members actually now probably thought that we have peaked. So I think we'll see how it goes. My personal view is I think the rates have peaked in US.
Right. Gurmeet, you have practically touched upon all the topics that we were going to discuss. But then, the Fed is projecting inflation to steadily cool while the labor markets remain historically tight. Now, a sustained imbalance in the labor market is more likely to keep the inflation stuck, above the target. Also, the headline inflation is likely to remain elevated due to the high, the rise in the energy costs. Is the Fed likely to revise its 2% inflation target then?
Unlikely in my view. They're saying that there will be 235 or something, next year. And also, mind you, they also have an election year coming. So I don't see, much thing happening there. Inflation, because of the tight labor market conditions, has been extremely sticky. And you rightly mentioned that, energy can play some spoilsport. But if you see the overall, at some, rate hikes have a delayed lag effect. So if rates remain longer, corporates find it difficult to service debt. Individuals are using more credit cards now. They're finding difficult as they dig into the savings. As per a report, U.S. Average citizen is almost out of savings it had accumulated in the COVID period due to various grants by the government, which means you're using more debt to service your basic needs and take care of inflation. So eventually it will have a huge impact on demand as well, which in my view could then mean that inflation can come off. So I think both things are related. We can't assume that the demand will also remain strong and rates will also remain very strong for long. One of them has to come down, and in all likelihood, because of the lag effect of rate hikes which happen, there will be some demand destruction which will happen. It's already started playing out in few pockets, especially the housing market in US. If you see, the impact is already there. So my view is that we should take it as it comes. But if Fed hikes more and it remains more hawkish, then for the time period, markets can consolidate.
Right. Gurmeet, along with the rate projections, the members also sharply revised up their economic growth expectations for this year, with GDP now expected to increase 2.1% this year. That's more than double the June estimate and indicative that the members do not anticipate a recession anytime soon. So that is the way for a higher treasury yield, which you did touch upon. How will that impact the flows from India? We have already witnessed FII selling in the last 5 days or so, and with oil also, hovering around that $93 a mark, it is likely to stay elevated. How is that likely to impact the Indian markets?
No, it will have short-term impact. But one good thing is that our dependency on FPI flows have reduced quite a bit. So if you see this year, YTD in secondary market, they are flat, right, in terms of net sales, which means, it's not that the market is not only just led by FI number. Including primary markets, they are upwards of 1.2, 1.3 lakh crores. But in secondary market, that number is flat. So the dependency is less. And also, I don't agree that the growth will also remain high and interest rates will go high. One of them has to. So if growth is high, it's not really bad news. It means that US will not have a recession. It'll be more like a soft landing, which in million term is not that news. But my sense is, as I said earlier, there will be a lag effect. And some of the risk, comes from unknown things. So when Silicon Valley Bank happened, nobody thought some of the banks in US will go down. Right? One bank went down and few more went up. So there's one risk which the market should be slightly very wary of. Even Fed will vary off, is that there could be some credit event at some point of time, because if rates remain higher for too long and their national debt is now $33 trillion, you can't maintain those high rates at that level of debt, both at country level as well as at household. And look at their data, look at the credit card outstanding, look at the mortgage outstanding, look at the student loan data. The debt is too much. So my personal view is that it can't remain very high for very long. I mean, while they're saying in the commentary, at some point of time, I think because of inflation coming down, even the rates will see some softening.
Right. Also, Gurmeet, with the oil, like I mentioned, hovering around the $93 a mark and possibility of hitting $100. And now Russia imposing a ban on gasoline and diesel exports from 21st of September, the news that's just come in. There is going to be a tighter, energy supply, which means elevated energy prices. How is that going to impact the inflation projections going forward then?
No, it will impact, and that's the risk we see. I think above 100 is where India gets uncomfortable. Up to 100, I think we should be able to manage with a better sourcing mix, even the usage mix, and with ethanol blending and focus others. So I think over medium term, I think that should be. But above $100, it will pinch us, and that's something we have to value. Also, mind you, a lot of this hike is more also supply cut driven by OPEC and all. It's not really demand driven. And I was looking at some data. US share in oil exploration again is going up. So if it's more supply cut driven, it's unlikely to sustain high for a very long period of time. But in the short run, I agree with you. If it goes up above 100, it's negative both for bond yields as well as equity markets.
Gurmeet, on that note, we'll have to let you go. Thank you so much for your time. Thank you so much for joining us on the Rush Hour.